Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a member of the business development team here at iCM. And today I'm joined by Ryan Lehman, iCM's Director of Investments. Ryan, thanks for joining us.
Happy to be here, Pete.
Great. So, hey, let's jump right in. Obviously, 2023 is off to kind of an interesting start. We had both equity and bond markets rally in January, only to give back a good chunk of those gains in February. Can you provide some insight into what occurred?
Yeah, absolutely. So not surprisingly, this kind of goes back to the usual suspects. So you had the inflation, and you had the Fed. So if we start in January, market was essentially trading on increased hopes of a soft landing. And this was really based on a number of encouraging data points. So we had a pretty significant drop in inflation from the month prior. And we also got a stronger than expected GDP report. And this all fed into kind of that narrative that the Federal Reserve would be able to either slow their pace of rate increases later this year or potentially stop increasing rates or even cut rates before the end of the year. And what you saw was this pretty meaningful rally in US stocks, especially on the growth side of the market. And then we saw this sharp decline in bond yields, which was a boost to bond prices.
So, really, what's fundamentally changed in February that caused markets to sell off?
Yeah, in reality, not that much. So inflation, it did continue to come down, albeit it was not as fast as investors would have kind of liked. And the economy and corporate earnings, they were generally okay, if not pretty strong. The major problem, though, is that the market just got a little bit too optimistic in terms of the future path of interest rates and started to become a little bit disconnected from the Fed. And this is actually pretty easy to measure in practice. So if you simply look at the Fed's dot plot, as well as just general Fed speak, what Chairman Powell and some of the other local presidents are saying, and you compare that to the futures market, what that's pricing in, you can get a pretty good idea of whether the Fed and the market are on the same page.
So, that's an interesting observation. How did this change this year? And really, are the two, meaning the markets and the Fed, both on the same page now?
Yeah, it's pretty interesting because the relationship it's changed pretty meaningfully over the last few months. So we came into the year generally on the same page. So this is why you saw a little bit of a reprieve in bond volatility toward that end of 2022. However, as we got those encouraging economic reports in January, you started to see the market become more and more dovish than the Fed. In fact, if you looked at what the market expected in terms of the terminal rate, if we were to look on January 31st, they expected a terminal rate of about 5% at mid-year, so at that June meeting, with the expectation that rates would actually be below 4.5% by the end of the year. So actually indicating that the Fed would be cutting in the latter half of 2023. Now, if you look at the Fed dot plot from just a month prior, so they released that in December, you're going to see a completely different story. So you had the FOMC median expectation for Fed funds just about 5% at year end, and you even had some members predicting a rate of over 5.5%. So clearly here, these two parties weren't on the same page. Now, over the last month or so, we've gotten a few hotter than expected inflation reports, as well as some really strong job numbers. And these have been kind of a reality check for the markets, and they've started to bring interest rate expectations back down to reality and really much more in line with what we've heard from the Fed recently. Now, unfortunately, what this has done is it's resulted in a retracement of some of those gains for both stocks and bonds that we saw in January. So we had the S&P 500 that sold off by about 2.5%. You had the ag give back just about the same. And if we look at where yields are today, you've got the 10-year trading right around 4, and you've got yields up pretty much across the entire yield curve.
Got it. Great info, Ryan. And so just to wrap up here, what do you feel that this means for asset markets as we look out over the rest of the year from this point forward?
Yeah, so for equities, we'd expect to continue to see some volatility here, at least in the near term. We've got a good deal of uncertainty that's still swirling around a potential recession and whether we're going to get a soft landing, a hard landing, or potentially no landing at all is the kind of the buzzword now. And then how that's going to impact earnings later on this year, especially in the middle part of the year. That said, though, bonds, they're really an area that we're a lot more optimistic. So the reason being there is that bond yields, they tend to price in expectations for future interest rates. And now that we've got the Fed and markets relatively aligned, volatility should be pretty muted going forward, unless we were to see something expected like a resurgence in inflation. That said, though, even if we do get um, that type of situation, your downside at this point, it's kind of mathematically limited by the fact that you're starting from a higher yield and you've also got significantly less interest rate risk or duration than you did last year. So just to wrap up with kind of a simple example, even if rates were to increase by about 100 basis points from here, so assume the 10 years at about 4 today, the 10-year goes to 5% in the next 12 months, the Bloomberg Ag would only experience a loss of, say, about 1%, 1% or so. So nothing near what occurred in 2022.
Great. Ryan, again, thanks for joining us today. Um, Really great to see you. And as always, our business development team is happy to address any other questions that a viewer may have. You can reach out to us at info@icm-invest.com or by phone at 888-426-4689. And we want to thank you for watching this episode of Mic'd Up with ICM.